Broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to this week's webinar with One Resource Group. My name is Tony Wilson, Executive Vice President of Sales here at One Resource Group, and we're excited to have our good old buddy Ron Lee on the call today. And we're going to talk a little bit about some of the estate tax laws that will sunset next year. It's probably the hottest topic, and number one request that we get is more information on the estate tax law sunsetting and some opportunities in this space. So before we have Ron take it over, a couple housekeeping items. If you have any questions, feel free to use the chat feature. We'll ask those questions at the end. And second item, at the end of the day, we're urging a lot of our agents and advisors to get the planning done, for their clients this year, and not wait till the last second, because next year, assuming nothing changes, there's going to be a lot of very busy attorneys and CPAs, trying to help out their clients. So that's all I'm going to recommend. So Ron, you want to take it away, buddy?
Yeah. Hey, thanks, Tony. And thank you, everybody, for joining us today. If you detect anything on the slides not moving forward or something like that, please let me know. But otherwise, I think we've got some great information for you today, because we really do have a rare opportunity to help people out in planning for a law change that's so far in the future. I mean, when was the last time you had 22 months to plan for a change in the law? And granted, we could have started planning back in 2018, but nobody actually does that, unfortunately. So we should be grateful to have nearly 22 months to get this done. And there's a lot we can do. So let's just run through this. Obviously, put any questions in chat, and we'll make sure that we get those answered for you and go from there. So here's what we're going to talk about. We're going to talk a little bit about what the Tax Cuts and Jobs Act did, at least as it relates to the upcoming sunset of the gift and estate tax expanded exemption. Talk a little bit, we're going to lay the groundwork for how gift and estate taxes work, some of those exemption amounts, how to take advantage of the increased exemption before it sunsets, because obviously that's why you guys are all here. And then finally, a little bit about trusts and life insurance and how we might best use those as we are figuring out what to do with these exemptions. Now, what I will tell you, the Tax Cuts and Jobs Act was a lot more than just the expanded estate tax exemption. There were a lot of things that are actually going to sunset here in 2026, whether it was the reduced income tax rates, phase outs of the child tax credit, limitations on itemized deductions. A lot of those things are going to change. Again, that's not what we're talking about today, but I just don't want anybody to leave with the impression that this is the only thing that changes next January. Maybe sometime we'll do a presentation on all the other stuff, but this is the one that really impacts what we all do on a daily basis. So the thing that I want to focus on is the sunsetting of the temporarily doubled gift and estate tax exemption. So what was it before? Before the Tax Cuts and Jobs Act, it was about $5 million adjusted for inflation, and $10 million if you were married, also adjusted for inflation. Because of TCJA, it went to $10 million, $20 million for a married couple, again, adjusted for inflation, which is going to take us up to $13.6 million. Now, the interesting thing about doing estate planning for the last couple of months is that wipes out a lot of our potential client base, right? I mean, married couples with more than $27 million don't make up the large majority of our book of business, let's be honest. So a lot of people haven't been thinking about estate tax planning, but they're going to have to, because on January 1 of 2026, which is less than 2 years from now, it's going to be cut in half back to $5 million adjusted for inflation. Our guess is that it's going to end up at about $7 million, but we don't have a crystal ball. So we think that's where it'll end up, but we'll just have to wait and see next year what happens there. And frankly, we have a presidential election this year, so in theory, a lot of things could change, and this might not sunset. But we don't have any choice but to plan with the laws that we have. So that's what we're going to do today, and we're going to help you help your clients. So in order to do that, we need to have a quick review on gift and estate taxes. So it makes it a lot easier to understand this unified system if you understand that gift and estate taxes really are kind of one system of transfer taxes. And when I say transfer taxes, the government doesn't just tax you when you make money. They also want to tax you when you want to transfer money to somebody else. And that comes in the form of a gift tax, an estate tax, or theoretically a generation skipping and transfer tax as well. So they are going to get theirs, whether you earn it, whether you spend it in the form of sales taxes, or you save it and you eventually end up giving it to somebody. But remember that the federal gift tax is a gift tax made on transfers that you make while you're alive. And that tax is generally paid by the donor. Now, can you avoid it? Absolutely. Well, you can avoid it. You don't pay gift taxes when you give money to a U.S. citizen spouse. You don't pay gift taxes when you give money to a charity. But beyond that, for non-charitable, non-spouses, you can use an annual gift tax exclusion. And that's now up to $18,000, which means that that's $36,000 that a married couple could use per beneficiary. So if I wanted to, I could cut a check to everybody that's on the call here for $18,000. And if I could get my wife to agree to it, we could cut you a check for $36,000, and we wouldn't have to use any of our lifetime exclusion. But let's say we wanted to give you more than that. If you want to give more than the annual exclusion, or if it doesn't qualify for the annual exclusion because it's not a present interest gift or something like that, then you use your lifetime exemption after that. Again, that's up to 13.6 million per person at this point. So that's a lot of lifetime exclusion to use. And what people don't always understand is that if I make a taxable gift, I don't actually go out of pocket to pay gift taxes until and unless I exhaust my entire lifetime exemption. So this idea about there being a gift tax, annual gift tax exclusion, only being $18,000 and theoretically giving away millions of dollars, that's okay. You're not paying out of pocket. You're just simply reducing the amount that you're going to have available to transfer at death. Like I said, if you, this is a transfer of wealth tax. So whether you give it away during life or you give it away at death, if you have enough assets, you're going to pay estate or gift taxes. So the way that you do it at death, of course, is you put everything that you own into a big pot that we call the gross estate. You make some deductions, and eventually, if you have no tax, or if your estate is worth less than 13.6 million, then you don't pay any estate taxes upon your death. And of course, if you used any of that, so if you gave away $1 million extra during life, that would be 12.61 million, right? Because I said when you make a taxable gift during life, it reduces your estate tax at death. Couple of things to keep in mind. The current gift and estate tax rate is 40%. That's actually the top rate, but that top rate comes into being after $1 million. And so anybody who actually pays gift or estate taxes will pay them at the 40% rate. Don't forget, some of you could be in a state that has its own estate or inheritance tax. And if that's the case, then you may want to do some estate tax planning for your clients that are in those particular states. This is stuff that I've pretty much already covered, so we'll go quickly. The estate and gift tax system is a unified system, so you either give it away during life or you give it away at death. And if you don't give it away during life, you have that remaining exemption left over. So here's what it might look like if I died this year, for example, and I'm not John, but let's say John died in 2024 when he had a $13,610,000 exemption. And let's say John had given away property 2 years ago, and that gift was valued at $2 million. We know he didn't pay estate taxes, and we know that if he dies this year, he can have up to an $11 million, $610,000 estate without paying federal estate or gift taxes. So what did TCJA do? I think this chart does a really good job of visually showing you where these exemptions are. So from the years 2018 up until January 1 of 2026, we got this thing called a bonus exemption. And that means that the part that is not shaded is a basic exclusion amount. And that's why it just goes up a little bit for inflation every year from 2015 to what we're projecting out in 2030. And obviously, we don't have a crystal ball. We don't know what it's going to be in the future. That'll depend on inflation adjustments and theoretically congressional action. But what we do know is that the way the law is written right now, I don't just have a basic exclusion amount. I have a bonus exemption amount. And the other thing I know is that not only do I have a bonus exemption, but I either use it or I'm going to lose it. And I would prefer to not die before January 1 of 2026. So I should think about giving away property if I'm ever going to be, if I ever have to pay estate taxes. So I think this is a really good chart that will help us understand what that might look like in different scenarios. So here we have a single person. Her name is Jackie. She dies in 2026, and let's say that her exemption at that point is about $7 million with inflation. We're going to keep it nice and round number, so it'll probably end up about 7 million. That won't be the exact number, I'm sure, but it's probably pretty close. We know that she has not used any of her lifetime exemption, so this is going to be strictly looking at what she has to give away now and what she has available at death. So if Jackie has a $20 million estate and she made a gift of her full exemption amount this year, that would be $13,610,000. That would leave her $6,390,000 in her estate. Now, let's assume that that doesn't grow for the next couple of years. Again, we're doing this to keep the math easy. So in 2 years, her estate is still $6,390,000. At 40%, her estate tax liability is $2,556,000, leaving $17,444,000 for her heirs. That is the best case scenario. She used the full exemption, including her bonus. Now, what if she just went a little over her exemption? So she gave away 10, and a lot of people will do this. They are not comfortable giving away a huge amount of their wealth if in fact they might think that they might want it back. So maybe she makes a $10 million gift, which leaves her a $10 million estate. So she pays, or her estate pays, $4 million, leaving her heirs $16 million. So mathematically, she didn't optimize it, but it is certainly better than giving a gift under the bonus, which is the next example, where she gave away only $4 million. And then we know that the exemption went back down. And so she only had $3 million of unused exemption left. And that means her estate tax liability on 13 million was 5.2 million, leaving 14,800,000, which is the same result if she just gave away nothing at all, right? Now, for our purposes today, it's the same result. Now, you guys know that assets grow, and if she gave away that property, that there'd probably be some growth on there. But for today's purposes, if she gives away less than the full basic exclusion amount and doesn't get into her bonus, then she hasn't taken advantage of the bonus exemption at all. So really important. It's very similar, and this is an important strategy to understand. In this case, we have Sam and Brenda and dying in 2026. They haven't used any of their lifetime gifting exemption. So the strategy here is going to be, we are going to use one full lifetime exemption prior to sunset. So let's say in this example that Brenda gives away $13,610,000. We know that the net, I won't go through all the math with you again, the net to the loved ones is $29,244,000. If she used just 10 million of that, she's leaving $27,800,000 for the family. If you give under the bonus, so within the basic exclusion amount, or if you give nothing at all, then there is no difference. So we didn't help ourselves by not giving more than just the basic exclusion amount. This is really, really important, because if you have clients who are thinking, hey, we have $10 million to give, why don't we give $5 million from Sam and $5 million from Brenda? And the problem is that then neither one of them is using their bonus exemption. They're both only using the basic exemption. So if you have people who want to give away some or all of that bonus exemption, you really should be thinking about the fact that, hey, they really ought to think about using one person's exemption and not necessarily both of them. So that leads to the next important question, and that is, what are the implications here? A lot of people wanted to know, well, if I give away $10 million and the exemption goes back to 5, is the IRS going to say, well, you died after it went back to 5, so we are going to claw that back? And the answer is that no, they're not going to claw that back in, except in some limited situations where maybe you gave away something with a reversionary or retained interest. In those cases, if you're not going to give something outright, I really recommend that you speak with good counsel before you do it, because you would hate to find out that you gave away something, maybe forgave a promissory note right before 2026 and thought it was going to be out of your estate. That would be bad. But as a rule, if you give away something using your bonus exclusion amount, it's out of your estate. So you don't have to worry about the clawback. And they even came out and they said that. So that's good. Another interesting thing that came out of some of those clarifications were, what about this portability? What about a deceased spouse unused exemption amount? So those of you who have been around for a long time, like us, know that before 2010 or 2011, there was no thing called portability between spouses. So we had to either use a bypass trust or credit shelter trust in order to use both spouses' exemption. So for example, if I were to die in year 1 and then I gave everything to my spouse, which most people would have done, prior to portability, that exemption was just lost. It didn't double my wife's exemption amount. It was just gone if I did not use it by giving away property or doing a bypass trust or something like that. But they changed those rules. And now the rules say that my wife can elect to use my unused exemption amount. So if, for example, I were to die this year, she would still have the ability to tack my unused exclusion amount onto hers when she ultimately dies. And how much would that be? This is the good news of the portability and dying discussion, I suppose. And that is that if one spouse dies before the sunset, they actually, the deceased spouse unused exemption is that full amount with the bonus. So you could have one spouse die in 2024, pass $13,610,000 worth of exemption to a surviving spouse. Then that surviving spouse dies in 5 years, and maybe they only have $7.5 million, but at least you preserved that first exemption. So that's a really good result to know that that portability works in that way. So what are we doing now? I want to pause for just a second, actually, and just make sure that no questions have come in that we should address before we finish up.
Yeah, Ron, we had a couple questions come in, but one you haven't answered yet. So what are your thoughts on any new tax cuts happening before the sunset, or are you hearing anything from this front?
Yeah, and that's a great question. And I think what we discovered back in the early 2000s is that every one of our crystal balls is broken, right? Because we thought back then that there was no way the estate tax was going to get repealed in 2010. And I said that pretty consistently for 9 years until the estate tax got repealed in 2010. So that's difficult, right? Now, I think most people presume that there is a difference in how perhaps Republicans and Democrats view the estate tax. That seems to have been less clear, maybe in the last few years, at least to me. But one might think, depending on the results of what happens in November, that you could see some change. But I'm sure not hearing any rumblings of people making changes to the estate tax. And frankly, it just feels like, and this isn't partisan at all, it just doesn't feel like anybody in Washington is getting anything done at this point. So I don't hold out much hope that they're going to change this before it sunsets in 2026, but we'll see what happens after the election and whether maybe people can get some more stuff done out there.
Awesome. The questions, you actually answered a couple of them in your presentation already. So.
Well, good. Okay. Well,
actually, one just came through. You mentioned next January, doesn't it sunset December 2026? Actually, it sunsets December 2025.
So correct. Yeah, the last day that you can die with the bonus exemption amount would be December 31st of 2025. Right. So it changes January 1st.
Thank you.
Yeah. No, all right, good questions. So for the rest of this, I want to go a little bit more practical and talk about what are we going to do here about making these gifts. We all know that mathematically it makes sense to do that, right? But now the question becomes, how do we do it? And in general, this is a very general statement, obviously, but you can make gifts directly to loved ones or directly to anybody. They don't have to be a loved one, I guess. You can make gifts to them, or you can make them to a trust where they will be a beneficiary. And if you do that, then obviously you're maintaining some control over the gifts that you would not if you just wrote a check to your kids, for example. So many people, especially in a high net worth space, are really going to want to talk about trusts. So what kind of trusts are we talking about? I don't want to go back to the beginning of trusts, but other than to set the table with this. There are two kinds of trusts, really, and they are revocable or irrevocable. Revocable trusts are great because they can help you reduce your probate fees, for example, because it's not in your probate estate. They can help provide for a person so that they have a successor trustee to manage their finances if they become disabled. It can help avoid probates in multiple states if people have property, real estate in multiple states, for example. So those are all great. What a revocable trust does not do, though, is it does not remove property from your estate. And sometimes I'm kind of surprised at how many people think that if they set up a revocable trust, that somehow that's helping them with their estate taxes. And it doesn't do anything from an estate tax point of view. Really, a revocable trust where I'm the beneficiary and the trustee is not an income tax event. It's not an estate or gift tax event. It's just going to help me on my probate fees, my management during life, and so forth. In order to get some benefit of removing something from my estate, if I want to use a trust, it needs to be irrevocable. So Why would I want to do an irrevocable trust? Well, I mean, let's be honest, I'm going to lose control of those assets. And people don't like that. They spent their whole life trying to accumulate assets. And then someone says, well, if you don't want your family to have to pay estate taxes, then you should think about giving property to an irrevocable trust. And that is a real impediment for a lot of people because they can't go in, take their money back. They can't modify an irrevocable trust. There are more flexible options than maybe there were 20 years ago, for sure. The grantor would have a more difficult time modifying it, and frankly would have to do that with the consent of the trustee and depending upon your state, maybe even the beneficiaries. But if you go into an irrevocable trust thinking that it's not ever going to be irrevocable, you're probably going down the wrong road. And it also can be a little problematic if you're doing income tax planning as part of your estate planning. You do have to remember that if you gift an asset to an irrevocable trust, it takes over the basis of the donor. So you probably don't want to do a really high value, low basis asset that would get a step up in basis. So if I bought Microsoft stock back in the 80s or 90s, that would be a terrible stock for me to put in because I want that to step up to its fair market value at the time of my death so that whoever sells it next in line, my wife, my kids, whoever, will get a step up in basis and won't have to pay so much in capital gains. But it's a great way to remove property from a taxable estate. It's the only way other than making direct gifts. When you start thinking about what you want to put in, you really want to put in an asset that's either going to appreciate in the future or somehow you get a discount or some type of leverage. Because I don't want to put $1 into an irrevocable trust and have my trust beneficiaries get $1 of value. Not when we can do some good planning and say, well, let's figure out how to leverage that dollar, or let's give $2 worth of value that because it's discounted, maybe only is going to use $1 of my exemption. So how are we going to do this in our example? In our example, let's talk about an irrevocable life insurance trust. You might be doing this by making $18,000 or $36,000 annual gifts. You could use that full exemption, drop a bunch of money in initially with a sizable gift because you want to use your bonus. You do have to remember that it is irrevocable. And the great thing is that not only is that removed from your estate, so it's not making your estate tax situation worse, but it actually, if you're in a liquid asset or life insurance, that will provide the funds that you can use. So quick example here, we have Jackie in this. She's age 60 in this example, preferred non-tobacco. And we just took her $10 million exemption that we talked about. We dropped $10 million of cash into the ILA, used and not her full exemption. She still has $3 million left. But for our purposes right now, she put $10 million into the irrevocable trust. We bought our Life Protection Advantage, which is our death benefit focused product. And $10 million immediately buys $37 million guaranteed to age 90. So age 90, you're almost quadrupling the money. Now, what did this do to the contract? It made it a modified endowment contract, but it's really important to understand that if you're not going to take withdrawals from the policy, you don't care if it's a modified endowment contract. MECs are not taxed differently from a death benefit point of view. So we can drop it all in, and as long as it carries the policy, you're good to go. And in our example, you can see that we even did an increasing death benefit at age 100 on the non-guaranteed side. That had grown to $43 million. And so it really can do very, very well. And design these well, because if your clients are more worried about the alternate scale, and they say, well, I want it to go longer than age 93, then you probably wouldn't want to use an increasing death benefit. You'd want to find a different way to guarantee to run that out a little farther. But still a fantastic example of how you can use leverage inside of the ILET. You gave away 10 million, but your heirs are getting at least 37 million if you die before 90, and theoretically a lot more in this example. So what about our couples? We mentioned earlier that some people like taking advantage of the increased exemption, but they get a little worried that they might need the money later. The thing that I have discovered after all these years is that as much as we would like to make estate planning a mathematical exercise, it isn't. And so the only way you will ever get to the conversation to talk about how are we going to transfer the most wealth in the most efficient way is to first have the conversation to say, how much do you need to feel comfortable that you have enough for yourself? Because enough that is not a mathematical term, right? You can try and make it mathematical, but it's a feeling. So how much income do you need? How much of a buffer do you want to have? How much are you comfortable giving away? Those are all conversations. Until people think that they are taking care of themselves and their spouse first, they don't care about the estate tax. So just make sure that you don't jump out ahead. But here is something that you could do that would help people feel more comfortable. Instead of giving all that money to a traditional irrevocable life insurance trust, they could consider what we call a SLAT, or a spousal lifetime access trust. And with that, you're giving money or property to an irrevocable trust. And while the donor does not have access to those funds, the spouse will. So it is a great way. And if you have a good marriage and you're living together, then you are benefiting from the money that your spouse gets. So it is a great technique, and it is not out there on the edge. It's not crazy. All the estate planning attorneys out there would have heard of it, and the IRS does not have it in its crosshairs like happens with some of the concepts we talk about. But with this, again, the spouse can continue to benefit from the assets. So it does not have to be life insurance inside of a SLAT. Sometimes people will put other types of assets that will accumulate or distribute income. But if you're going to use life insurance, you definitely want a cash accumulation policy. So some things that you'll want to think about. Number one, there's a doctrine called the reciprocal trust doctrine. So if you ever tell your clients about the SLAT and they say, I love it, I'd like two, one for me and one for my spouse, that can be done. But if they're identical, then you have a problem, and the IRS will try and uncross those trusts, is what it's called. Very, very easy for a good estate planning attorney to draft around that issue. I just want to make you aware of it today. Divorce is an issue. If you have clients that you're working with and that marriage doesn't look solid, don't recommend a SLAT, because that's how are they going to access the funds if they get divorced, right? So you really do have to be careful and not necessarily assume that a SLAT is for everybody. And there are just different considerations to help you avoid some of the things that might get those proceeds included in either spouse's estate, one of which is that you don't want to completely drain the donor spouse of cash to where it looks like, frankly, the other spouse just gave the property. So that is, we could do a whole session, and I know Tony and I have done a session before on SLATs and other flexible trusts, but something to consider for sure. With this, wanted to use our income advantage, which is our cash accumulation. In this one, I went ahead and made Brenda 55 years old. And in this case, we do not want this policy to be a MEC, because we want to get the cash out of the policy. So in this case, the $10 million of the gift, we are going to drip into the policy over the next 10 years. Is there a more efficient way? Yeah, probably. But that is a nice, even round number put in $1 million a year for the next 10 years. Again, she's 55, preferred non-tobacco. And what that shows is that if you start the disbursement phase at 50 or 66, you're actually projected to receive $912,467 for the next 55 years, which is crazy, right? They don't have to take all that because it's still in trust and you still want to try and transfer some money to the next generation. But why am I showing you a 55-year distribution period? Well, a couple of reasons. One, I think it's compelling, right, to tell your clients that you put money in for 10 years and then you take money out for 55. But the other reason I do that is because it stress tests this a little bit, right? The one thing we don't know about IUL is whether it will outperform or underperform the projections. You can't know. Nobody has a crystal ball. We know that this can't be the exact number. So what we can do is we can go in and say, hey, well, how do we stress test this? Well, you could run it at a lower rate for sure. You could take less than the maximum amount for 10 years, 20 years maybe, or you can run the distributions out to age 120, because what that does is that means that the policy that WinFlex has to calculate a distribution that is low enough that it doesn't lapse the policy until age 120. So it drives down the income that you're getting out of it. Why do you want to do that? Because then you don't have to go back and tell your clients sorry, right? If it turns out that the policy does underperform, you say, okay, well then either we continue to put a little bit more money in, or we take a little bit less out, or you just don't take the money until you're 120. But you have at least 3 levers to pull that will help your clients if you run that income out to age of 120. So what type of policy do you use? Again, if you're going to distribute income like with the SLAT, use a cash accumulation product. If you want death benefit, then you want a product with a guarantee like our Life Protection Advantage. I know, because we do estate planning, we don't have a second to die. And so I know that there are a lot of attorneys and CPAs out there that will just say second to die is cheaper. So you should buy second to die because you don't need the money until the second death in many estate plans. But here's the things I want you to consider on whether second to die really does make sense. And that is, number one, if you want to provide for a surviving spouse inside of the ILET, then you need to have some insurance that pays at the death of the first spouse. So we have to have that. Second to die doesn't do any good for that surviving spouse. You have to remember that premium payments are going to continue until the second spouse dies. So they're only going to have one annual exclusion if they're continuing to fund, which means they can only give $18,000 per year, not 36 plus whatever that grows to with inflation. And honestly, if you have to pay for longer because you have to pay till the second death, and you're saving a little bit every year, are you really saving over the long run? Or would you be better off paying less or paying more, but for a shorter period of time, theoretically? And don't forget that a lot of times people will do second to die and frankly don't provide their surviving spouse with enough money to both live on and pay a sizable second to die premium, because they tend not to go down. So don't forget, your clients, the exemption might be going up now, but we know it's going down in a couple of years. And if they are successfully investing or growing their wealth, their estate value is going up. And it is going to be very easy for their estate value to outstrip the exemption in the short run. So use the annual gift tax exclusion, give to as many people as you want. If there's grandkids, even better. And then just remember that that annual gift tax exclusion does not expire. Again, these are all, especially if you're talking about clawback issues, things like that, get on the team with a good estate planning attorney in these cases, right? Nobody wants to do great estate planning and then go and get their trust off of the internet. So work with a good attorney, work with a good CPA, get on the team, and that will help you not just with the current client, but in the future as well. We have a tax reference guide with all of the numbers for 2024. If anybody is interested, then we could certainly share that. And with that, I appreciate your time today, and I hope that you will go out and talk with your clients, and don't wait till next year, because next year the attorneys and CPAs are going to be really busy. And the longer you wait in 2025, the less likely it is that they're going to be able to draft a trust between Christmas and New Year's for your clients. So get some planning done. If we can help, please let me know. And Tony, do we have any more questions?
It doesn't look like we have any more questions, Ron. One last thing I'd like to add is, a little commercial on Mutual Omaha side. Mutual Omaha has really good, conservative, low-cost fixed products on the permanent side, and it's one of our favorites because they have some pretty cool features with the Grow Rider that Ron talked about. They also have a good chronic and long-term care rider combo as well. So Mutual Omaha has just always been a really good partner of One Resource Groups over the years. But more importantly, they have very good conservative products. You don't have to worry about them being here today, gone tomorrow, and just a really good partnership. So Ron, thanks as always for the presentation. Excellent job. If anyone on the call has any cases they'd like for us to look at, or want to even consult with Ron, on a specific case, we can bring Ron on those calls as well. So thank you so much, Ron. We really appreciate it.
Yeah, thanks for having me, and thanks for attending, everyone.
Have a good week. Thank you.